Hello, welcome to the Mortgage Porter Weekly. I'm Rhonda Porter, mortgage advisor serving the greater Seattle area and Washington State, and this is your mortgage market update for the week of June 1st, 2026. Last week brought some important economic news, starting with inflation. Headline personal consumption expenditures, or PCE, rose by 0.4% in April, coming in just a touch below the expectations, but on an annual basis, inflation climbed to 3.8%. Core PCE, which strips out food and energy and is the Fed's preferred measure of inflation, rose 0.2% for the month. But the annual core rate edged up to 3.3%, and this is still well above the Fed's 2% target. The Fed is walking a tightrope right now, and inflation is running too hot, as we probably all know. And there are some signs of labor market is starting to cool. So adding to that pressure is the ongoing conflict in the Middle East, and specifically new reports that Iran is halting dialogue after Israeli strikes on Lebanon and is threatening to block the Strait of Hormuz. And this has real implications for oil prices, and when oil moves, inflation follows. On the housing side, nationally, new home sales fell 6.2% in April after 2 straight months of gains. Affordability is still a challenge for a lot of buyers, but home prices continue to hold up. The Case-Shiller index showed national prices up 0.7% year over year, and the FHFA reported a stronger 1.7% annual gain for homes backed by conventional loans. Looking further out, economists surveyed by Fannie Mae and Pulsenomics are projecting about 14% cumulative home price growth over the next 5 years. So on a $600,000 home, that's roughly $84,000 in equity. So something to think about if you're on the fence about buying. Now let's talk mortgage rates. According to the Optimal Blue Index, the average 30-year fixed mortgage as of last Friday, May 29th, was 6.438%. This is a slight improvement from where we were last week. But a couple important things to keep in mind is that the index reflects roughly 35% of mortgage transactions that is from lenders who use this platform when they go in to lock in a rate. And it's a helpful benchmark for tracking trends, but it is not a rate quote. We don't know how these rates are priced, if they have points or what somebody's credit scores are when we look at this, and it is an average. And you can't lock in Friday's rate today. I wish we could. There's just a lot of factors in this. So if you want to have your own personal rate quote that is current and based off of your personal financial scenario, I'm happy to provide that to you. No credit report required. Well, this week is Jobs Week, and it's one of the busiest on the economic calendar and one of the most closely watched by the mortgage markets. And here's what's on schedule. Today, Monday, the ISM manufacturing. Tuesday, the JOLTS jobs openings. Wednesday, ADP employment report, ISM services, and the Fed's Beige Book. Thursday, weekly jobless claims, and Friday is the big one, the BLS Jobs Report. And also, we do have the FOMC rate decision on June 17th coming up in just a couple of weeks. Now, if all that said, all of the data will be competing with attention with headlines out from the Middle East and what's happening with oil prices. A geopolitical risk has a way of moving mortgage-backed securities more than any scheduled report, so we'll be watching both closely this week. As of about 9:30 this morning Pacific time, mortgage-backed securities are heading lower. We're down about 19 basis points, which impacts mortgage rates. It means that they may be potentially moving higher. So the main driver is oil prices, and they are rising sharply, and that's tied directly to the escalating conflict involving Iran and concerns about the Strait of Hormuz. So when oil prices spike, inflation expectations rise, and that puts pressures on bonds, including mortgage-backed securities. And when MBS prices falls, mortgage rates tend to move higher. So we're keeping a close eye on this and how this develops throughout the week. If you're in the middle of a transaction wondering whether or not to lock your rate, don't hesitate to reach out. This week, I want to highlight something that doesn't get talked about nearly enough, and that's non-QM mortgages. Non-QM stands for non-qualified mortgage, and that just means that the loan doesn't meet standard guidelines set by Fannie Mae or Freddie Mac. But it doesn't mean that you don't qualify for a mortgage. It simply means you need a different type of mortgage program. And non-QM loans can be a great fit for self-employed borrowers, people of non-traditional income, or whose financial picture doesn't fit neatly into a conventional box. So there are a variety of programs available, including bank statement loans, asset depletion loans, DSCR loans for rental properties, and more. So if you've been told that you don't qualify, or if your income is a little bit harder to document, I encourage you to reach out because there are many more options than you think. And we have a suite of programs available for you, including our portfolio line. So you can learn more about non-QM loans in Washington State at my blog, mortgageporter.com, and I'll make sure that I have a link on below in the description. Thanks so much for watching this week's episode of the Mortgage Porter Weekly. If you have questions about your specific situation, whether you're buying, refinancing, or exploring your equity options, or just trying to figure out where to start, I'd love to hear from you. Visit me at mortgageporter.com or reach out directly. I'm always happy to help. I hope you have a great week, and I hope to hear from you soon. Take care. Bye-bye.